Having laid the foundations on your path to prosperity, we're now going to move into income management. How to budget, how to understand taxes, how to begin to understand the magic of compounding interest, and finally, how to even consider earning more money as you make your way down your financial path.
According to the now infamous Simpsons cartoon, alcohol is the cause of and solution to all of life's problems. Well, we all know that marriages break down because of in-laws. And finally, we know that people end up in the poorhouse simply because they didn't make enough income. Well, let me tell you folks, those are urban legends, and I say they're nonsense. Alcohol is not the source of or solution to any of life's problems. The number one reason for marital breakups in this country is a lack of communication between spouses. And finally, even people with average incomes make enough to retire someday in relative comfort. Why don't they then? What is it that keeps people mired in poverty? I'll share with you this one true fact, and this isn't urban legend. The difference between a next-door millionaire and his next-door neighbor poor guy is as simple as understanding budgets and budgeting. In the United States, our educational system teaches advanced physics, advanced mathematics, and advanced engineering really well. But they also fail miserably when it comes to teaching something so basic, so important, and so necessary as budgeting. My friends, this isn't complicated, but it can be life-changing. People frequently write me, call me, or see me and ask the same question. Why is budgeting so hard? Why can't I live within my budget? Why does it always seem to get blown out of the water? These three whys lead people to constantly live in a state of stress, constantly live in a state of confusion, and constantly struggle to make ends meet. This is so unnecessary. And as I've often commented, we live in the wealthiest country in the wealthiest time in history. Why then isn't everyone able to enjoy life without the enormous stress that comes with a flood of past due bills, debts we can't pay, and pressure to earn more and more every year? As a result of this continuous question being put to me, I've thought long and hard about why it is that people have such a hard time understanding budgeting and sticking to it. As I've thought and read about it, there are literally hundreds of books written about budgeting. I kept wondering why. Why don't we budget? Why don't we live within our means and our budgets? What I've come up with are two key points that I think explain America's failure to budget, both personally and with our institutions. It's simple because, quite honestly, budgeting is simple. But to do it, we must first have the right mindset. What mindset is that, you ask? Well, as I polled people about their budgeting practices, I found certain similar behaviors. When it came to their businesses or their jobs, they were both very good at setting budgets and living within them. They made the tough choices because the numbers simply don't lie. But when they got home at night, all of that seemed to go out the window. Go figure. We do a great job at work, but a lousy job at home. That's where mindsets change. Every good chief financial officer of a company sets a retained earnings target for his or her company. A very good and a rare company will generate, for example, a 10% after-tax return for its shareholders. 10%. That doesn't sound like much, does it? But 10% may be the difference between you retiring wealthy and you retiring to the poorhouse. Emblazon that number in your head, 10%. It's a small number that will make all the difference in your life. Undoubtedly, you've heard this before. I'm almost certain of it. But why then do people not have retained earnings of 10%? One of our reasons is simply over-optimism. We constantly overestimate our incomes and underestimate our expenses. Having spent my life in the world of small business where optimism must rule the day, I can tell you firsthand that one of the real difficulties in building a small business is toning down the optimism that got you into it in the first place. This over-optimism complex is needed, otherwise no new business would ever start. But it must be kept on a leash so as not to impact the concrete world of financial numbers. In addition to this natural tendency to overestimate income and underestimate expenses, budgeting sometimes seems so complicated that no one does it. There are hundreds, if not thousands, of software programs and phone apps that can help you do this. Why is it then that we don't? Well, I'll share with you why I think we don't. It's simply because we don't think of ourselves from the outside as a company, which is very much what we are in the financial path. Everything we do for compensation is no different than McKinsey & Company selling its consulting services for millions of dollars to the Fortune 500. Now, you might be saying, this is a huge load of bunk. How can you say with a straight face that I'm like McKinsey? I'll tell you simply, you are. And let me explain. A company exists to aggregate the services of a number of people, from 2 to whatever number, right? These companies then produce a service or a product that is desired by some segment of the marketplace, a segment that is willing to pay for that product or service. Some of the products are tangible, like cars. Others are intangible, like intellectual property, lawyers, accountants, consultants, and the like. These companies produce revenue by selling their product or service. They incur cost of housing their aggregated people resources, salaries for those people, and that expense list goes on and on. The goal of the business is to have its revenues exceed its expenses by some margin. And for U.S. companies that are well run, that's around 10%. Now, companies then pay taxes on that, so they net maybe 6%. Well, for a large business, 6% of $1 billion can be quite a lot of money. Well, this 6% becomes their retained earnings, and they can use this money for investing in other businesses, buying new equipment to enhance their value to their customers, or use it for a rainy day when business isn't so good and they need to live off their retained earnings or go out of business. So there's a 30-second summary of all that business is. Well, let's look at you. Your goal is to take yourself as your product and produce revenues by selling it to a customer. In a normal case, that's an employer. You incur costs of housing, transportation, medical care, education, food, spending, clothing, childcare, and that list goes on and on, just like a business. At the end of the day, most Americans have zero left over. I mean, wow, you're telling me that in the hyper-competitive world of business, they manage to save on average around 6.5% of revenues net, but people can't save any? Well, that's right. As the chief financial officer of our own business, we do a very poor job of creating lasting value. One of the foundational problems that are the root causes of this is that consumers are, and now here we go again with the myths perpetrated by Madison Avenue, consumers are sold a bill of good as to what's an investment versus what's an expense. I want to explore that with you because at the core of why some people are wealthy and others are mired in, I won't say poverty because that's a state of mind, but they don't have the money. They're mired in a world in which they live on much less than they desire. Why is that? My friends, sometimes I think I'm providing you information that is, well, common sense. But you know what? I've run into so many circumstances where people have just never thought about this stuff because it's boring, it's unexciting, it's complicated, or whatever, and they suffer for it. So I'm providing information like this because it's critical that a person understands it. And to those of you who say, I already know that, I say wonderful for you. But for the millions of Americans who don't, I say learn this and then welcome to the world of the enlightened ones. Okay, anyway, at the core, an investment is something that you acquire that retains or ideally increases in value over time. Also something that you can readily turn into spendable money when or where time calls for it. An expense is something you acquire that decreases in value over time. Okay, let me give you some ridiculous examples. On the one hand, that meal you consume at Applebee's that's right, it's an expense because once you've eaten it, it's gone. On the other hand, that bar of gold you bought that's right again, it's an investment because it's been acquired for reselling at some future date, and you have reason to believe it will hold or even increase in value. Okay, those are two extremely obvious examples, but many things aren't so clear to understand. What is a car? What is a house? What about that jewelry you bought? These are slightly more difficult to categorize, and Madison Avenue has made a mint persuading you that expenses are really investments. Why? Because people naturally don't mind investing as much as they mind spending. But how can a car be an investment when it depreciates to almost no value after just 6 years? And how can that jewelry you bought be considered an investment when you never intend to sell it, and frankly would never sell it? And how can that house be considered an investment if you've locked in a 100% loan-to-value mortgage and have no interest in paying down the debt, thus keeping zero equity? To adequately budget, you have to know where things fall. Okay, it's not complicated, but you need a framework that you can live with for the rest of your life. I'm going to jump ahead here and discuss an income statement. I'm sorry to get into accounting, but you must understand this. An income statement is a statement of revenue and expenses for an enterprise, a business, or for you. In the workbooks that are attached, we have sample income statements for people that you can look at. But the first thing you should notice when we do an income statement is that we force our 10% retained earnings in before what we call voluntary expenses. Why? Because we have to. It's that simple. I cannot say this often enough. Please, 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 for your own sake and for your heirs' sake, take the 10% that is to be retained and save it. The second thing is that I've put interest only in the housing expense. Anyone want to guess why? Well, the balance of your payment is principal, and that is not an expense. Let's remember our simple definitions. An investment is something you acquire that you have a reasonable expectation of holding its value or rising, and you expect you can sell it someday. Well, equity in a piece of real estate certainly qualifies. So what you are doing when you buy a house on payments is forcing an investment through the monthly payment you make to the lender. That's good, right? Well, the answer is yes. If and only if you're consciously doing this and with the understanding that you are committing a portion of your retained earnings to this real estate investment. Now, clearly, you can live in this particular investment, so it has another benefit attached to it. But at the core, you're electing to invest that portion of the monthly payment out of your retained earnings into real estate investments. Now consider that your house is a long-term investment, and real estate, which is a hard asset that is inflation sensitive, does belong in a portfolio. It's probably therefore not a bad idea to handle it this way. But there are two big assumptions. First, that you plan on living in the house more than 3 to 5 years, as we discussed in an earlier CD. And secondly, that you understand that you are, in fact, making a conscious investment into real estate. This should be considered as part of your assets and overall portfolio, not part of your expenses. The third thing you should notice that really stands out is on our sample income statements, there's no other debt, period. No Visa cards, no MasterCards, no Neiman Marcus cards, no Shell Station cards, none. And I'm not alone preaching this message. Dave Ramsey and others have been preaching it for years. If you cannot, based on your income statement, afford something, do not buy it. Fourth, I've included the car, and notice 100% of it is taken as a pure expense. Because cars depreciate so fast, rarely do you build equity. But if you do, then good for you. But in fact, we mentioned in a prior disc that the average length of time a car is worth its value is about 6 years. After that, nothing. Well, the fifth thing that you'll notice is a gift allotment of 10%. Look, I'm not going to tell you what to give your money to, but I will tell you this. Finding purpose in your life and truly living a life of prosperity, happiness, and joy means that you share your success with others. I know it seems difficult to right up front give 10%, and I'll be honest with you and tell you I've not always been able to make this. But if you get in the habit of it, you'll be incredibly more wealthy emotionally and spiritually, and you'll find a much higher purpose to your life because you'll know that you've positively affected others. And you know what? Most people give money away anyway, and they never really think about it. We drop a $20 bill into the box at church. We give a little extra to our children. Now, this amount, if you do it officially, is tax deductible, so it goes ahead of the tax line. By the way, just as business expenses, the interest on your home may be deductible as well, as are the property taxes. Now, I've taken that into account already in our sample income statements by adjusting the tax percentages, as these things, as well as gifts to charities, are tax deductible. Now, as you begin your budgeting process and therefore produce a statement of your income and cash flow, what do you do if you're already over your head? Now, we cover more of this under the emergency sections, but here you go. Here's a starting point for resetting your financial future. Number one, quit spending on anything but the necessities. I know this is hard medicine. I've had to do just that myself in the past. When I talk about necessities, I am not including cable television, cell phones, or anything else that is not directly related to your producing the income you have. This will reduce your expenditures, but if you're still underwater, our next step is to look at your fixed expenses, your house and your car. If you're underwater after trimming expenses as much as possible, you have to consider selling these assets, even if you get nothing out of them. Simply eliminating the payment might help you stay afloat. If you're still underwater, having cut spending and reduced your fixed cost, if your deficit problem is purely income, you might have to take a second job or do whatever you've got to do to raise your income. Now, let's talk reality, though. Most people aren't in trouble after cutting expenses and reducing fixed costs. They're in trouble because they're overloaded with debt. Okay, so you've looked at your budget and determined that you're underwater. First, you've cut every non-essential expense you've got. Then you considered selling your car and even your house, but that didn't work. Now you've got to tackle your creditors. Do not hide from them. They have little or no interest in either suing you or pushing you into bankruptcy. Most of them will give you a reasonable haircut on the balance due. For example, in today's world, if you owe a credit card, let's say more than $10,000, it's not unusual for them to cut that balance to $3,000 and give you payments over an extended period of time. Now, granted, this wreaks havoc on your credit score, but it's significantly better than a bankruptcy. So here's a quick summary. Number one, reduce non-essential spending. Number two, reduce fixed overhead. And number three, negotiate with creditors. By taking these steps, you very well should be able to get your budget back in the black, meaning that you have a positive bottom line. Cost cutting is never easy. Businesses do it because if they don't, they'll go out of business. For people, when the consequences aren't so tangible as going out of business and thus ceasing to exist, they tend to postpone the tough decisions until they become absolutely critical to make. Then, often they're so painful to make, they don't, which leads to catastrophic consequences. So prepare your budgets to earn a 10% profit. Live within your budgets and make a habit of it. And with that simple concept, you will be able to live a life free from the stress of unwarranted debt, free to make your own decisions, and perhaps free to retire from working for a paycheck sooner than later.
This crucial yet basic information will assist you in saving more money and help you budget more wisely for years to come. let's continue to other areas of income management. We all know the pain of the tax man, but what is the true impact of taxes on our lives and on our income? We need to understand this to move forward into a world of financial planning. The Steve Beeman Group is a non-political group, so we're not going to make subjective value judgments about these taxes. But we will, throughout this financial literacy program, discuss the true economic impacts. Let's again join Steve as he walks us through this wonderful world of taxation.
There are words and phrases in the American lexicon as well as concepts that send shivers up the spines of normal people. A dentist drilling a cavity, the words cancer or stroke. Added to that is the title of the most feared government organization that exists, the Internal Revenue Service. In fact, according to some, Americans fear the IRS more than they fear God. Why is this? What's so fearful about taxes that people shudder at the thought? And more, how do we know all of the taxes we pay? Which are progressive or recessive? As I contemplated topics in this library of information related to this volume, Income Management, I thought about the idea of what impacts income. Clearly, how we use our income is important. That's budgeting. How we raise our income is important. That's income improvement. But what about drags to our income? Well, there are many of these, and when I refer to a drag, I'm referring to something that slows down your income or is used but doesn't improve your standard of living. The largest component of most of our income is taxes. Now, with what we're about to discuss, I want to state this first. The Steve Beeman community that we're building is non-political, and therefore I won't make value judgments in this presentation about whether a certain tax is good, bad, or indifferent. My purpose is to educate you about taxes so that you have an eyes wide open view of taxes and all that you're paying, and you therefore can make educated choices about your financial plans and your political and social plans. What exactly are taxes? Well, I'm not going to go into the long history lesson because simply we don't have time, but it's important to note that taxes have been being paid to governments in one form or another for a very long time, thousands of years. If we go back to the earliest records of history, we find references there of taxes. The first governments, emperors, and kings needed income to fund wars and other programs that their own wealth could not fund. Taxes were taken as a crop, a coin, or labor, whatever was needed. In the United States, we have historically been a country that isn't too quick to allow government to tax us. In fact, prior to 1913 and subsequently the need to fund World War I, the United States had spent most of its existence with no federal income tax at all. The federal government was funded primarily by tariffs and the sale of public lands. Where there had been federally required income taxes, primarily to fund wars, collection was done by the states. So in the United States, federal taxes have been a battleground since our inception. The question is, what do you and I need to know, and how does this affect us? Clearly, we can vote our political ideology whichever way that falls. But what impact do taxes have on us, on our financial planning, our wealth creation? That is the true issue. So I'm going to ask you to bear with me here as I present some rather academic discussions about issues related to taxes. I'll try to keep these brief. First, you must understand that there are different types of taxes. 3 that immediately come to mind. The first is a wage tax. That is taxing what you earn. You see this in the form of income taxes and employment taxes. Second is a consumption tax. You see this in the form of tariffs and sales taxes. The third is a capital tax. That is wealth that has been created and saved after the first 2 taxes have been paid. You see this in the capital gains taxes and inheritance taxes. Each of these has its own pros and cons, and this debate about which ones to raise, which ones to lower, that's been with us forever, and it will likely be here long after you and I are gone. So concept number one, there are three primary types of taxes: income, consumption, and capital. Concept number two, some taxes are progressive, meaning that the more you earn, your relative percentage increases. A person making $50,000 per year may pay 10% on the next dollar earned, where a person making $250,000 a year might pay 39% of their next dollar earned. This is known as the marginal rate, and a good example of this is our own federal income tax. Now, other taxes are neutral, meaning that everyone pays the same. Some call this a flat tax. A good example of this is Medicare. The person making $50,000 per year pays 2.9% on every dollar earned, and the person making $250,000 would pay the same 2.9% on every dollar they earn. The third is regressive, meaning that the less you make, the more you pay. A good example of this is Social Security tax. A person making $50,000 a year pays 12% of their income, or $6,000. A person making $250,000 a year pays around $13,000, or 5.2%. Now, for each of these types of taxes, someone will say that's not fair. So the debate goes on and on and on and on. Well, concept number three, people react economically to changes in the marginal rate. For example, if the top rate changes from 39.6 to 35%, people will react to that by switching behavior toward earning more income. On the contrary, if rates change from 39.6 to 42.6, for example, people will react by switching behavior to earning less income and, say, more capital gains. I would argue that this real change in behavior is relatively short-lived as the new tax rate becomes the norm. Then, in order to get a change in behavior, the rate would again have to change either up or down. This change will lead to changed behavior until the new rate becomes the norm. The million-dollar question is always, how high can this go until it causes people to just quit being productive? No one knows the answer to that, of course, and that is the debate. Now, the fourth concept, no one knows the optimal level or optimal structure of taxes. Politicians try, now let's be honest, they try to maximize revenues to the government first and then to impose social policy as a second objective. So now today, we have a tax code that is thousands of pages and costs the U.S. over $20 billion a year just to complete tax-related questions. It's got so many loopholes, deductions, special taxes, and everything else that you and I, as just plain people, could never understand it. Fifth, there are two competing schools of thought on the purpose of taxation, what's called neoclassical and the other is Keynesian. The neoclassical camp sees taxes, and therefore government spending, as a drain on the economy that serves only to dampen individual incentive and creativity. The Keynesian camp sees taxation, and therefore government spending, as a positive and stabilizing economic influence. The recent financial bailouts were quintessential Keynesian economics attempting to stimulate the economy. The Keynesian approach had the government borrow around $1 trillion to then spend it as a stimulus. The neoclassical approach would have had the government borrow the same $1 trillion, but then used it to provide tax cuts to individuals and businesses and let them decide how to stimulate the economy. Well, the final concept that needs to be understood is that government, for all of its bad, does attempt to serve the society by virtue of how it sets tax priorities. The United States is a representative government, and thus does reflect to some extent the will of the people. As a society, we have certain interests that are clearly shared, national defense, roads, and all the like. Others, though, perhaps aren't so clear, And these programs range from schools and education provided to our nation's children, to the National Endowment for the Arts, to National Public Radio, aid for dependent children, and everything else. We debate the need for and the level of funding for these constantly. To the extent the Steve Beeman Group is neutral, we try not to make value judgments about these programs, but only work to inform you so that you can decide how these realities affect your life, your planning, and your wealth. But only work to inform you so that you can decide how these realities affect your life, your planning, and your wealth. So, quickly to summarize these 6 keys, there are 3 primary forms of taxes: income, consumption, and capital. There are 3 primary natures of taxes: progressive, regressive, and neutral. Third, in the real world, people do react to marginal changes in the rates. Fourth, the U.S. tax code is enormously complicated. Fifth, there are 2 competing camps, Keynesians and neoclassicists. And sixth, voters ultimately do decide where taxes get spent and thus what taxes are. For much of my life, I've lived among the academics who see the world as it should be. That is perhaps how a computer model says it should be, but not always as it is. As much as I've lived among them, though, I'm still very well grounded in the real world of how things are. So when we explore taxation, we need to know how these taxes affect us and what we should do based on our view of the financial journey we're on. First, let's look at our paychecks to see where we stand. There are 2 primary types of taxes you'll see drawn from your paycheck: the income taxes from the federal government and state government, if your state has an income tax, and then the employment taxes paid for Medicare and Social Security. In other messages, we've used the example of the average American family with a $60,000 income. This person will have 4 taxes directly withdrawn from their paycheck, and several that are not. Let me discuss these visible and invisible taxes based on a $5,000 per month income in Illinois. Now keep in mind, taxes change from state to state. This family's income is $5,000. From that, they will have an average of around 15% withheld for federal. That's $750. In Illinois, they'll have an additional 3% withheld, which is $150. For Medicare, they'll have 1.45% withheld, which is $73, and Social Security 6%, which is $300. That leaves them an income of $3,727, or about 75% of their gross income. So this person is paying around 25% in total taxes, at least those that are shown. Well, what other taxes does this person not see? Well, first of all, the Medicare and Social Security taxes have an equivalent amount paid by the employer. Well, even though the employer is ostensibly paying it, it reduces the income to our family by a similar amount. Now, in addition, there's federal unemployment tax and state unemployment tax. Therefore, on an annual income of $60,000, this person is paying around $20,000 either directly or indirectly in taxes. This represents a total income and employment tax of around 34%. Now, if you're self-employed, you tend to see this because the employer portion of Social Security and Medicare are paid by you via the self-employment tax. More often than not, this is the largest item in a person or a family's budget. Now, just for information, the peak percentage paid is roughly at $110,000 in income. This person, assuming they have the same family structure, would pay around 35.6% of their income in income taxes. Raise that income to $200,000, and the percentage actually drops to 31%. This happens due to the recessive nature of the Social Security tax, which has a cap today at around $110,000 in income. Now, before that makes your blood boil, you must understand that Social Security was started as an insurance program. Thus, the maximum premium paid in, or tax, was supposed to balance out with the maximum benefit you could receive. Therefore, the $110,000 cap on salaries on which Social Security is paid represents the premium necessary to support the maximum payout allowed under Social Security law. So as you plan your budgets, plan on seeing on average around 25% of your paycheck withheld for direct or indirect tax payments. If you're self-employed, plan a tax bite of more like 35% due to the self-employment taxes. Now, the second type of tax we discussed is the consumption tax. You generally see this as a sales tax, and the important thing here is that for some of you, sales taxes are deductible as they are a state tax, and the federal government allows you not to be double taxed, so you can deduct sales taxes from your federal tax return. So depending on your income and your other deductions, plan on saving receipts so that you can add up your sales tax expenditure and then deduct that amount from your federal income taxes. Now, there's a whole lot of talk today about a national sales tax, implemented most likely as what's called a value-added tax or a VAT tax. What this basically represents is a sales tax added to each level of production by the manufacturer. One of my recent SBG casts covered this item. Well, the bottom line of a VAT tax is it causes there to be effectively a one-time adjustment to the prices you pay. As the manufacturers are required to add the tax cost to their products, you'll ultimately pay that tax via an increased price charged by the manufacturer. As a consumption tax, this tends to increase the savings rate for a country because people are less incented to spend money as prices rise. Now, this, of course, depends on our next category, taxing capital. One of the core missions of the Steve Beeman Group is to help you build financial wealth. That is, if that's one of your objectives. Therefore, we're going to try to help you both generate and save capital or retained earnings. Capital, remember, can be as simple as a passbook savings account. Capital represents anything you've saved, and since it's almost by definition based on savings you've earned, you've already paid tax on it. Let's take our sample family of $60,000 in income. After paying directly 25% of their income in taxes, and then paying housing, transportation, medical costs, education, food spending, and everything else, let's assume they save our suggested 10%, or in that case, $6,000. This $6,000 becomes their capital. Now, they have the ability to invest that capital. They can do that by loaning to someone, or they can buy an asset. These actions, either loaning or buying assets, can generate two forms of capital taxes. If the individual loans their retained earnings to a person or a company, then they earn interest, and that interest is taxable as income under normal federal and state tax rates. Thus, the person who has saved $6,000 and then buys a bond paying 5%, which earns $300, they once again pay federal and state income taxes on the $300. In their case, that would be about $54 or 18%. The percentage is lower because under $250,000 in annual income, you don't have to pay the two employment taxes of Social Security and Medicare on interest income. But as a result of taxation, their net return is reduced from 5% to 4%. The second type of tax on capital comes from the capital gains you realize through buying and selling assets. When you buy an asset, say a share of stock, you have a claim on the company's earnings and profits up to your percentage of ownership. So there are two ways to capture your right: dividends and then the sale of the asset. Dividends are paid and considered distributions, and thus are taxed as short-term capital gains under regular income tax rates. Now, sales of your stock shares can either be short-term or long-term. Under present law, long-term capital gains, and this is where an asset is held more than a year, the tax rate ranges from 0 to 15% depending on your income. Short-term gains are taxed at your normal income tax rate. So you can see there's a large incentive for our investor to purchase assets that improve in value. If his income rises, and thus say he's in the 28% marginal category, he only pays 15% on capital gains if he buys and then sells an asset after 1 year. This is certainly not a reason to make an investment, but it's a nice perk that comes with buying an asset rather than just loaning money. The final thing I want to cover with you today is the variety of tax deferral and tax avoidance products. It's logical, reasonable, and understandable that individuals try to minimize but not avoid taxes. Understand that each of you has a different situation, and so what I'm saying is generally true, although there are most certainly, specific situations that affect you, and so you should seek professional answers to your specific questions. With that said, there are some basics you must know. First, always file your tax returns and do not try to hide your income, period. That's a violation of all types of laws, and you will get caught. Don't believe those people who say on the internet that you don't have to file taxes. You do. Now, if on April 15th you're not able to pay your taxes, at least file. Just by filing, you'll avoid many penalties. Now, second, there are ways to postpone taxes, which is a good thing. Let's recall our example of the $60,000 wage earner who saved $6,000. By setting up an IRA or an individual retirement account or buying an annuity, they can defer taxes until they hit retirement. In the example we gave, deferring taxes would immediately raise the rate of return for that individual back up to 5% from the after-tax 4% they had. Owning a home can be a good tax break given that you can deduct the interest and the property taxes, but check with your accountant on specific circumstances. Now, given that you cannot deduct rent, that's a built-in advantage to owning a home. Again, though, receiving tax breaks alone are not necessarily the motivator to make economic decisions. Yes, you should consider them, but taxes are not everything. So wrapping up, understand that taxes always have been and always will be with us. If we want roads, hospitals, schools, national safety, we need taxes. Now, for your planning, be aware of the direct taxes that you pay on your income, as well as the indirect taxes. Should you become self-employed, those indirect taxes will quickly become direct. There are subtleties that you can rest assured on regarding taxes. First, generally they go up. Let's remember that government doesn't like to shrink. It's not in its nature. So rising taxes to fuel rising spending are things to plan for. Also, as we've said, do not try to game the government by hiding income. They'll find you and you'll go to jail. It's far better to just file, pay your taxes when you can, and emotionally just accept them for what they are, a tax. While they're never pleasant to pay, and we universally think we're taxed too much, let's try to focus on good things that we can control. If we make $60,000 and pay 25% in taxes, and then make $100,000 so we pay 30%, let's focus on the increase in our income situation, not the increase in our tax situation. It'll only make you upset, and it will serve no positive purpose. Remember from the emotional path, control what you can, let go of the rest. So let go of the tax issue. Be smart, be prudent, and try to always minimize your taxes, but don't stress about it. I've been asked many times how I do my taxes, and I'll tell you, for the past many years I use TurboTax by Quicken. I have a very complicated return, and I found that TurboTax is easy to use, comprehensive, accurate, and inexpensive. So I use TurboTax and their full services, including their auditing services, by the way. It's worked well for me, and I believe it will for you too.
From short to long-term planning on taxes, this information is a tremendous benefit to you. Taxes are a huge part of everyone's lives, so Steve Beeman has strived to help you better understand some of the complexities and to help you in this area of income management.